Is the worst over, or are we just in the middle of the eye of the storm? In this video, we're going to break down 3 different analysts' opinions on what's actually happening in the economy. We're going to start with Morgan Stanley. Morgan Stanley says, we're in the eye of the storm. We're going to go through the actual document together, and then we'll get into the maybe more bullish pieces. But Morgan Stanley has an interesting point of view. First of all, when you're in the eye of the storm, it's really important to remember what that means. What it means to be in the eye of the storm is the weather's actually really calm. See, unless you've actually lived through a hurricane, you might not know, and that's not your fault, but the eye of the storm is actually the most calm part of a hurricane. In fact, when I've lived through hurricanes as a child in Florida, during the eye of the storm, you had like a 30-minute period to go outside and there was no rain, no wind. You chat with your neighbors, see how the first half of the storm went, and then you go back inside for the second half of the storm, which depending on which side of the storm you were on could be worse or better. Usually that top left quadrant is the one that spawns all the tornadoes and is really bad. So it's kind of TBD in terms of where we are, but enough of the analogy. Let's actually get into the document. So conversations have talked about, hey, has the market stabilized and is the worst over? Morgan Stanley actually, and here's where they talk about the eye of the storm, Morgan Stanley has a little bit of a negative view on this. They actually say, look, the market is appropriately selling off because, as we know, valuations are pretty high. All you have to do is look at the S&P PE ratios, either trailing or forward-looking, and we're at a historically high set of valuations for S&P 500 companies. It's also worth remembering that 30% of S&P 500 revenues come from, guess what? International markets. Now, of course, in the near term, that has led a lot of people to say, okay, I'll just invest in the stocks 50, Europe's, blue chip stocks, or I'll invest in Chinese exposure, which honestly has outperformed since the beginning of the year. But other people argue that's just really a potential fad right now to diversify from the US. But remember, if the US, the world's largest economy, actually goes into pooper doopers, everything could get impacted. Now, that said, let's see Morgan Stanley's take. And remember, they're going to be more of the bears out of these 3 analysts here. So take a look at this. They say the real slowdown is yet to show up in the hard data, and they think that there's more bad news to come ahead, mostly because the 4 things that they thought could have been potential growth drivers for the United States are currently not. That would be tariffs, not a current growth driver, maybe in the long term. Fiscal, cutting government spending is not a growth driver. A lack of immigration is not a growth driver, and deregulation is not a growth driver, which at this point. In the future, maybe we'll get enough deregulation or we'll get enough homegrown manufacturing that will be there, but that doesn't seem to be the near-term case. We're still waiting for those tax benefits, of course, but Morgan Stanley touches on those as well as some of the analysts touch on those as well. And one of the arguments that we'll end up finding is we might need more than just tax cuts at this point. And this is something that I want you to think about going into this. When you have an economy that is slowing, usually the way you stimulate a slowing economy is by either printing more money or taxing less. Okay, so we could do that. But the Trump tax cuts right now are expected to be an extension of the 2017 tax cuts, which means we're not actually getting tax cuts by passing an extension of the 2017 tax cuts. We're merely avoiding a tax hike. And so you'll see one of the analysts ends up arguing that we need more than just what we had in 2017 to stimulate growth in this economy. We actually need bigger cuts. Now, whether we get those or not remains to be seen. Keep in mind, Republicans are expected to pass their tax plan through just simple budget reconciliation, which means they only need 51 votes, and they're filibuster-proof if they utilize budget reconciliation. And in English, it's going to be really hard for the Democrats to block them as long as, Republicans get it done before midterms. Okay, fine. Those are all aspects to consider here. But what else does Morgan Stanley tell us? Well, they say that right now, fiscal is contractionary, as in the government isn't going to spend more, so we can't see this. We know that tariffs with April 2nd looming are probably a downside, but they could be an upside too, right? Like, what if Donald Trump comes out bullish and we're back to free trade? Fantastic. However, then we also have what Morgan Stanley argues, an unappreciated drag of immigration, sort of a lack of immigration into the country, which, of course, a lot of folks say, hey, well, just, cares about immigration. Like, Americans can do that job. There's a small problem with that in that it's kind of unlikely that the fired government bureaucrats who are now potentially looking for work are willing to take the jobs that illegal Americans were doing. And, vice versa. It's unlikely that those illegal workers were, working for government jobs, right? So they fill different places of the economy. So somebody will benefit, but people might also in the short term be interrupted by those disruptions. But anyway, markets substantially overestimate both the likely speed of deregulation and its ability to push growth. This is something that I've talked about as well before, that some of the problems with the Trump hope that we saw in November, that tax cuts probably won't really be meaningful for us if we get more tax cuts until 2026, because we're already expecting the base cuts. The new cuts probably won't be beneficial until 26. And deregulation also takes quite a while. You can start slashing government, agencies like the Consumer Financial Protection Bureau. But when do we actually go back to, the ludicrous level of 2006? I mean, that could be a decade from now. Who knows? But anyway, by the way, that's going to be a bubble at some point in the future. If they cut the Consumer Financial Protection Bureau, there'll be a huge bubble again at some point in the future in lending. Who knows? Maybe that's what we're seeing in buy now, pay later right now. The CFPB was trying to rein in buy now, pay later. And now what we're actually doing is we're buy now, pay latering for our DoorDash orders, which honestly is a little bit crazy, but whatever. We got more of this to cover here. So, are all of these cries about recession overdone? Probably. The strongest evidence to date is in the soft data, and we will continue to lean on the hard data over the soft data. So even though Morgan Stanley is actually a little bit bearish, they say they're not that bearish that we're going to go into a recession. This is actually somewhat bullish. If, some of the more bearish arguments of these three pieces that we're going to review are coming from someone who's actually kind of like, recession's probably overblown at this point. Hey, that's actually not that bad. They say in their forecast, the meaningful slowing might not show up for another quarter, but we will be following non-farm payrolls data even more closely than usual. You know me. Labor market slowdowns are the last thing that rolls over in a recession. But what is interesting from this Morgan Stanley piece is they're arguing, hey, we might not actually see the worst of the data until guess when? A quarter from now. The problem with that is in a quarter from now, that's when we expect to see maximal impact from tariffs. So if they see signs of potential sentiment leading data to roll over, well, when tariffs actually hit in April, we'd be aligning both of those potential negativities, the sentiments potentially rolling over to hard, but then actual hard data showing up and maybe lower durables purchases. We get a durables report this week. I think it's Wednesday. And also future hard data, which all culminates in sort of a June ouchie wouchie, which is also, double this up with what Deutsche Bank says, which is, hey, in October is when we're probably going to see the biggest impact from tariffs. June might just be the start. That's when you're going to have your most economically sensitive time. So that's important to look at because Morgan Stanley is kind of like, I don't know, like we could be done, but maybe we're just in the middle of it. And we still have another 3 to 6 months to go. Worth paying attention to. And we'll align this with some of the others are saying as well. Now, I want to get to the next piece. Quick note before I do, House Hack has a non-accredited raise going. I haven't posted a full dedicated video yet on the Meet Kevin channel, but there's a full one over on the House Hack Homes YouTube channel if you want to check that out, or just go to househack.com. I plan on making a full dedicated video as well, but if in the meantime you want to get a little bit of insights, feel free to check these out. Ask us questions, send us emails over at ir@househack.com. Check out all the properties that we have renovated over here. You can click the invest button if you're accredited or non-accredited, and you can diversify to real estate while earning a 5% yield with downside protection and the upside of a stock. Learn more about that, obviously, over at househack.com and the disclosures related to that. Now, let's talk about Citi. So Citi says, we're going to get some clarity from tariffs around April 2nd, which now we're being told maybe, just maybe, will be a little bit more targeted. Maybe we won't get this sort of blanket global tariff set, but this information could do poorly or lead to poor results for risk. I actually found this really interesting because a lot of people think that tariffs are going to lead to inflation and that that'll lead bonds to do poorly. But Citi actually makes the argument that risk assets like stocks or crypto would do poorly and bonds would actually do well. This is interesting to me. Now, I look at some of their arguments to get a little bit of an idea of, where's their mindset coming from? What are they seeing? And First thing I notice is they say that if the end goal is 15 to 10% on tariffs, even though we have a whole variety of scenarios, we're probably going to end up somewhere at least 15%. And this is what it forms really the basis for some of their opinion is, okay, we're going to go into this with about a 15% tariff on a lot of different products. As a result, they say that risks are two-sided. And I want to read this one because I think this is an interesting line. Of course, the market has already priced in a tariff shock to some extent. This is what you hear a lot of bulls saying right now. Oh, it's already priced in. Let's go to the moon. I'm all for everybody going back to the moon because I don't want to see pain and suffering. And I think there are opportunities no matter how you invest. It's actually a lot of what we talk about over in the Meet Kevin membership, where you can now get access to every single course, alpha report, private live stream, trade alert, everything, all 8 courses and everything with one small daily subscription, essentially. You can see the prices over at meetkevin.com. It's less than $1.60 a day. Go check it out. You get access to everything immediately. If you don't like it, cancel after 30 days. No harm, no foul. But take a look at this. If people are saying that we've already priced in a shock to some extent, then, hey, does it matter? Like, let's just buy the dip, right? They say, though, the experience so far has suggested that tariffs are not necessarily overly lasting and may change if U.S. corporates are getting impacted too significantly. In other words, if corporations complain, then Donald Trump is likely to sort of unwind the tariffs. Kind of like what they did with the auto tariffs. If you remember back to when we got our blanket 25% tariff on Canada and Mexico, with the exception of energy, they really quickly exempted cars. Like, almost immediately, they exempted cars for a month. And then they're like, okay, well, we'll actually also exclude anything USMCA compliant. And so the Trump administration does react to complaints from the industry, which is a bullish thing, right? Because it means there's some flexibility. Now, the market, however, in their opinion, might still underappreciate the ultimate negative tariff outcome, right? They say the tariff announcements could turn to be more benign than expected, maybe because tariff gets phased in over a longer period of time. However, there is that risk about the markets having underpriced and assuming that Trump is going to be too accommodative or potentially benign with his results. And therefore, Citi's conclusion here is we would rather buy back the market on a benign outcome than go very long into the tariff decisions. Okay, let me clean that up a little bit because it's a little bit of a messy paragraph. Basically, they're saying, look, we're going to sit on the sidelines until we figure out what the tariffs are. Mostly because even though markets have priced in some level of tariffs, we don't know what the true impact of them is going to be. When it comes to who will underperform, they say the case for being too cautious into tariffs is relatively easy to justify. So in other words, hey, it totally is reasonable to be cautious going into this. The question of who will underperform, though, is hard to answer. In 2018, it was China and international markets, which is the opposite of what's happening so far right now, and the U.S. had outperformed. Literally the opposite is happening right now. China and international are doing better than the United States. And so they reiterate that over here. And this is why they say we're tactically downgrading the United States. Okay, interesting. So they're not exactly the most, how would you put it, bullish, but they're also not super bearish. They're like, hey, look, if we can get past this, we're ready to dive in. We're ready to get back into the market. Okay, good. So far, I'm not actually seeing huge Wall Street panic. I think when you start seeing Wall Street panicking, it's probably when you're closer to the bottom, honestly. Like when all the analysts are mega bearish, that's usually your sign to buy, right? The contrarian play. But anyway, take a look at this. Citi ends up saying that the best asset could end up being cash. They say cash maintains its relative appeal to late last year, and that our cash allocation is usually the residual of the other positions, but now they're actually interested in being bullish on cash and the ability that cash provides them. It's actually one of the reasons why we're offering that 5% yield at House Hack, because at least on the channel, a sort of broad suggestion, free financial advice, if you will, like not personalized for you. I think increasing your cash allocation, like Citi says, is smart. But not only do I like the idea of increasing your cash allocation, I like the idea of increasing allocations to things like cash yielding private equity and equity that's outside of some of the bubbly sectors. Like, I kind of think real estate is a deal right now and will continue to be a really good deal. That's why we're hoarding cash at House Hack, because we're going to go shopping in Q3, Q4 when most people are panicking that their listings haven't sold and inventory is flooded, and we're going to be able to shoot fish in a barrel. You get to be a part of that if you invest in House Hack, househack.com. And you get the 5% yield on top of that. So it's kind of diversifying away from the stock market. You get a yield, and you're going into sort of what a lot of people see as an undesirable sector right now, which is usually when I want to be buying, when nobody else wants to, right? And so that's what we're going to be doing Q3, Q4. So cash yielding assets, this makes sense. But what does Goldman Sachs tell us? So unfortunately, on my Goldman Sachs piece, my highlights disappeared, but I'll go through the highlights anyway because I've got a lot of memorized because I didn't read it too long ago. So first of all, Tony, who is the sort of chief hedge fund coverage strategist or whatever you want to call him over at Goldman Sachs, has a few opinions. First, he says, the economy slowed down, but growth has not collapsed. Like, you cannot call right now a recession. A lot of people disagree with that. A lot of people say right now, I feel like I'm in a recession. That's bullcrap. And I think there are a lot of reasonable arguments to be made that we're actually experiencing a rolling recession, like Cathie Wood says right now. However, Goldman Sachs, Tony here suggests that, growth so far, like the hard data, isn't showing us falling off a cliff, which is very similar to what Jerome Powell told us at the FOMC meeting this week. I haven't seen the data yet to say we're definitely falling off a cliff. The worst thing that we actually face right now are multiples. Multiples on the S&P 500 are sitting, in excess of 24, 25, 26, somewhere in that range. And if you look at the Cape-Shiller ratio, either of those statistics, we're at like all-time highs on valuations. Now, yes, markets have come down, but only about 5% or 10% off these crazy all-time highs, for the broader indices, some stocks more dramatically. And the more dramatic moves are really a sign of what can happen when PEs compress again. To some extent, as an example, Tesla was a little overbought. I think everybody can agree with that. Going to 480, a little overbought. And that's not to say anything bad about Tesla. It's just to say, hey, you got a little euphoric there after the Trump win and basically Elon, buying his way into the White House. There's a lot of enthusiasm around what that could mean for the future of self-driving and manufacturing or otherwise. But eventually PEs, multiples, valuation multiples, tend to compress. And so Tony argues that the entire market actually has a little bit of an overweight position. And he says that while traders may have removed their allocations, a lot of longer-term holders, what he calls structural holders, like households who are really exposed to stocks right now, highest exposure in history to stocks right now, households who are overweight to equities and aren't trading are actually over-allocated to stocks, and they haven't trimmed high valuations yet. They've kind of just taken the bleed. So yeah, people's portfolios have gotten hit, and that might be you, where you're like, damn, yeah, man, I had stocks at, 125 pounds here, 480 Tesla or whatever, and I was looking at my portfolio like, damn, that's pretty good. And, now it's like, it's still good, but it's not as good as it was. This is fine, but Tony makes the argument that you really get this true panic when the structural sellers start selling. And so far, what we have are structural people still buying. Households and people broadly are buy, which is fine. Anyway, irrespective of the market bias, when you take a half a step back, it's stunning how much is going on right now. And even if implied volatility has settled down, the market continues to metabolize a huge range of significant variables. The result is a trading environment that is profoundly different from the past few years, to say nothing of entire blocks of time. What follows from the point, the post-GFC period was dominated by unbounded Fed policy, fiscal spending, and unrivaled U.S. tech preeminence. All right. Basically saying, look, we're going into this environment where you don't have that fiscal spending anymore. Tech dominance maybe come into question a little bit, and the Fed isn't supporting you. This sounds a whole lot like what Morgan Stanley said over here in their 4 kind of issues, if you will. Now, something that I thought was really interesting about Tony was Tony over here in paragraph number 6 says, holy smokes, the Meet Kevin membership is a great deal. Check it out over at meetkevin.com before Meet Kevin raises the price on the membership. And if you get in now, you lock in that low price forever. So in other words, if you want to lock in that low subscription now, before we raise the price of that subscription, you're guaranteed the lowest price of that subscription and you keep it. We're not going to raise that existing subscription price on you. Only new subscribers would have to pay more. So check that out over at meetkevin.com. Now, what Tony actually says is, whatever your market view, I'd remain flexible on where this all leads. Here I'll invoke the wisdom of Jesse Livermore. When you're doing nothing, those speculators who feel they must trade day in, day out are laying the foundation for your next venture. Where I'm going with that is, the year is not yet 25% complete, and the degree of difficulty is very high. So the preservation of capital is as important as anything else right now. This line right here coming from Goldman Sachs, hedge fund coverage, like head of hedge fund coverage, is pretty powerful. Because they're basically like, you have a hedge fund telling you, we're like focusing on preservation of capital right now over trading. Now that's in part what we've been doing, at least, what I've been doing and talking about in the course member live streams, where I'm a little bit more choosy with my trades. Last week we had an S&P 500, it was a NASDAQ 100 play that went up like 125% in the 40 minutes after my alert on it, which is amazing. And I took great profits on it. Hopefully you were able to take great profits on it as well. You get those alerts on the Meet Kevin membership, mind you. But there's certainly fewer trades going on right now because you have to be more careful in this environment. And I think that's what Goldman Sachs is saying as well. It's like, we want to hold that cash, that optionality, which makes it a hard time for a lot of the AI companies or the tech companies to really raise money. Again, this is where I think there's a really good opportunity to get a steal of a deal on companies that are exposed to real estate like Househack. But then again, I'm a little bit biased, and I think we're actually selling the shares for a wedge deal for buyers. You could learn all about that and what our Wall Street valuation is as we were ready to IPO. We got a valuation from Wall Street. You could learn all about that over at househack.com or watch the video over at Househack Homes on it. And if you want, you can always join me in a live stream as well and ask questions about it. But anyway, Tony makes this argument that, it's hard to know right now where the Trump administration is going to go with tariffs. And this is a pretty big line. You ready for this? Look at this right here. The U.S. consumer shows that sentiment surveys look like dirt, and the pressures on low-end consumers are accumulating. However, again, the high-end consumer is holding things stable. So what's going on? Is it weather? Is it not? Is GDP going to go down to 1.9%, or is it going to go negative? Who knows? But there's a lot to talk about here. And I think when you put all of this together, what you kind of have is Morgan Stanley, Citi, and Tony over at Goldman Sachs. They're all kind of neutral. They're kind of in the middle, like, we got cash, we don't know what to do with it. Shout out, by the way, to whoever has this plushie. Max gave it to me, and we call it the Good Luck plushie. I don't even know what it's from. I mean, I'm sure it's from some kind of game, but anyway, thanks, Max. Good luck. But what's interesting is all three of them are kind of like, it's not going to be that bad, I think. But we like cash and bonds. Yeah, I agree. Like, I want to be bullish, but I'm kind of like, cash and bonds. That's why we're doing bonds at Househack, right? And I put $5 million of my own money into Househack because I'm like, that's a good deal right now. I'll put some into that and some into treasury bonds and some into cash, right? That's how I like my portfolio allocated right now. I can't wait to go buy the dip again. I just don't think that right now is that opportunity. That doesn't mean I'm bearish. I'm just bullish on other things. Anyway, so then Tony makes this argument that what's interesting about the episode relative to this one when you compare to 2018 is all of the differences. In 2018, I hate the phrase different, this time is different. In 2018, the market came to believe that the Fed policy put was much further out than thought. Basically, Powell rolled earlier than thought. The problem now is because of the uncertainties, we don't actually know when we're going to get the Powell put. The Powell put could come a lot later than we expect. Now, it probably will arrive at some point, but it could be too late. Things could have already gone quite poopy by then. So I don't know. It's going to be really interesting. But all I know is we're raising cash. and we're going to buy houses and have cash for optionality. We've already raised over 7 figures, by the way, for House Hack. Congratulations to all the House Hack investors. There are a lot of first-time investors who are investing more money because they want the 5% yield and they want the downside protection. They want the upside as well. Again, you can learn all about that at househack.com. And I'll put a link down below to a private live stream that we're going to be doing probably right before I post this video. So you can watch it back on 2X if you want. It's sort of like a free sample, if you will, of kind of what like a course member live would be like, plus Q&A and market commentary. So this is sort of the kind of live stream that we like to do daily in the course member live streams as part of the Meet Kevin membership. So I'll put a free sample as a pinned comment down below and in the top of the description. Thanks so much for being here, folks. We'll see you in the next one. Goodbye and good luck out there.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.